Hey, what's going on, guys? This is BloodFanSim81. Welcome back to my channel. Today I'll be talking about an article which is 15 stocks in the FAANG Junior Varsity League. And for those of you that don't know what Junior Varsity means, it's basically like a step below Varsity. So FAANG would be the Varsity, and then these stocks are in the Junior Varsity League. So it's basically stocks that aren't at the same level of FAANG right now, but still have a lot of potential to grow. And so one of the things I really like about this article is that it kind of addresses exactly how I feel about FAANG. So FAANG is usually really large companies, so $100 billion plus. So what that means is that they're able to move the market pretty easily. They're also growing really quickly. And this is most important, they're dominant players in their industry. So social media king, Facebook; e-commerce king, Amazon; streaming king, Netflix; digital search king, Google; consumer tech king, Apple; and AI king, Nvidia. So that's exactly why I feel like FAANG stocks are so strong, is because obviously they're very large, but they're leaders in their respective sector. Not just that, but these sectors are completely changing the way that we live our lives. I made a more detailed video called My Thoughts on FAANG, so I'll go ahead and link that in the description below if you guys want to check that out. But yeah, it's very clear that our lives are different because of these companies right now, and it's because these like industries right here, they matter so much to us, such as social media and digital search and consumer tech and etc. etc. So if you think about it, however, tech is a really broad field, and there's going to be a lot of kind of subsectors within the tech field. So there's things like cybersecurity. There's software companies and hardware companies. There's some companies that are more lean than other companies. So today I'll be talking about the different dominant players in each of the subsectors, or most of the subsectors, I should say. And maybe you guys might get inspired and pick one of these stocks to invest in. But I'll go ahead and give my thoughts on them. So stock number one is Square. So Square is completely changing the way that we pay. So pay for services and pay for goods. And that's because of the cashless revolution. So I'll go ahead and read the first two sentences of this paragraph. Payment processor Square is at the heart of the cashless revolution. Thanks to growth in e-commerce, mobile commerce, and card transactions, hardly anyone is using cash these days, which is exactly true. We are currently in a cashless revolution, and people will continue to lose cash less and less. So Square makes it possible for a lot of us to pay without cash at a lot of businesses and restaurants. And there's just a lot of potential here, in my honest opinion. So, and they're at the forefront of that as well, which is awesome. So Square, the chart looks amazing. I would consider getting into this one. It reminds me a lot of something like Nvidia, where if you look at a long-term chart, it's pretty intimidating because it only goes one direction. And so you're kind of wondering when to get in. I would treat this one the same way I treat Nvidia, and that's basically every time there's a 10% discount, I would probably get in. And it's only gone one direction ever since its IPO here in late 2015. Let's see how much it's grown since 2016. So it's grown about 730%, which is pretty nuts. If you compare it to something like PayPal, which is actually pretty similar, which is e-commerce payments, or e-payments, I should say. So PayPal has also IPO'd here in late 2015, and ever since 2016, it's gone up about 175%. So that's clearly a lot less than Square, and that's solely on the potential that Square has. So Square has capitalized a lot more on the person-to-business transaction, rather than PayPal, which is person-to-person transaction. So I do like Square. Next on the list is Roku. So a lot of you guys know what Roku is. You know that Roku went public not too long ago. And I'll go ahead and read this, a couple sentences from this article. So just as Square is at the heart of the cashless revolution, Roku is at the heart of the cordless revolution. So thanks to over-the-top services like Netflix and Hulu, entertainment consumption habits are shifting from linear to internet, which is exactly true. Not only are we in a cashless revolution, but right now we're in a cordless revolution, and people are cutting the cord. I don't even have cable in my current apartment right now. My parents don't have cable in their house anymore. So this is a very real change that's going on with us. And so Roku is at the forefront of that. So they're working with a lot of these companies. Even though Roku does provide its own devices, their operating margin is still pretty lean. And that's because they make money off of ad revenue and commission revenue. So basically, if you sign up through one of these services using Roku, Roku will get some commission off of that transaction. So it's kind of like an all-in-one entertainment system, which is awesome. If you think about it, there's a lot of potential like that. Yeah. So let's go ahead and take a look at Roku's chart. It is insanely interesting to me, actually. So one thing I want to say about Roku is you guys know that I love LA wave analysis. So that's basically, if we take a look at something like Roku, this looks to me like 5 waves up. So 5 waves up, and then so this is wave 1, and then this would be wave 2, which is an expanding flat, so ABC, which lands directly at the 0.618 retracement, which is exactly what we're used to. And so that would mean that this is a wave 3. So at the minimum, if this is a really shallow wave 3, I can see a price target towards around $70, which we can't see on the chart, but I think it could hit 70 even this year, and pretty soon actually. So I do like Roku's chart a lot. And on top of that, I like stocks that take off right after their IPO. So if it's strong after the IPO, that gives me a better feeling than something like Snapchat, for example, which, by the way, is the next stock on the list. So Snapchat, what can I say? So I do own Snapchat. I think that it's really popular among younger people, and it has a really simple way of making money, which is ad revenue. So businesses will basically pay to have their stuff on Snapchat and have their own stories and things like that. But to be honest, if sentiment was better on Snapchat, it would be reflected in the charts. So I'm not beating myself up for not getting at $12. I would like to see some higher highs and higher lows before getting to Snapchat. This has basically been nothing but lower lows and lower highs since its IPO here in 2017. And I really do not like this chart at all. Just full disclosure. Has a lot of work to do. It reminds me of something like Twitter. So Twitter, since its IPO, went up a lot, and then it kind of just made lower lows and lower highs. So this is pretty similar to Snapchat, around like this range right here. It eventually bottomed here around $11 and then kind of just took off. So I do like Twitter a lot better now. I think Snapchat has a lot of work to do before I consider investing, however. Next on this list is Axon. So this is AAXN. So yeah, I'll go ahead and read these two sentences. So everything is going digital, which is true. Companies are going digital, consumers are going digital, governments are going digital, even law enforcement agencies are going digital, and that is where Axon dominates. So whenever we have a company that can kind of monopolize an industry, there's usually a lot of potential just because of that. So if Axon can corner the law enforcement agency market, which, by the way, a lot of law enforcement agencies, police departments, sheriff departments, and we're talking local and national, still have a lot of work to do in terms of getting caught up with AI and tech. A lot of big data involved with law enforcement agency. Obviously, there's a lot of crime reports, things like that. So if Axon is on the forefront of it, I do think it has a lot of potential. Take a look at a chart. So I did draw like a triangle consolidation pattern. So it broke out of that at the start of 2018, and right now it's on the pullback. This chart is pretty odd. Let me go ahead and make this green since it's support now. So this chart is pretty odd. Yeah, it didn't actually consolidate that much at 2018. Actually, yeah, so when the rest of the market was consolidating here, Axon was kind of just taking off, and right now it's taking a breather. Yeah, I think I might get a little bit of it right now. We'll see. I guess I'll leave it at that though. So I'm a little perplexed on this one, so I'll probably put a question mark on AAXN. It's like 50-50 right now. But yeah. Next stock on the list is Grubhub. So I really do like Grubhub. Basically, anytime there's an earnings report, Grubhub would crush it, even if it's below analyst estimates. And that's, a big part of the reason is because, in my honest opinion, Grubhub will continue to benefit from the fact that it's the only public food delivery company right now. And I think in about 5 years, there might just be 3 or so. So I know there's smaller companies like Postmates and things like that. But these big conglomerates like Grubhub and DoorDash are buying them. So there's like on the West Coast, there's a lot of food delivery companies such as LA Dining or Dining In, things like that, which Grubhub has purchased. Grubhub has purchased Seamless as well. What else have they purchased? The Yelp, E24, things like that. So in a few years, Grubhub will be one of the leaders in one of the fastest growing industries in the United States. And so food delivery is already pretty big in Europe, I want to say, especially because the roads are a lot more friendly for food delivery. Even grocery delivery has been a lot more common in Europe, and people just tend to buy their groceries and get them delivered to them in Europe more than the US. With that being said, however, I think people are generally getting more lazy, and that's why food delivery is growing. And the more common that it gets, the cheaper delivery fees will become, and that'll be a positive feedback loop, and the more people will use these food delivery companies. So I do like Grubhub, simply for the fact that it's the only publicly traded food delivery company right now. And I think in the future it'll just be Grubhub, Uber Eats, and DoorDash, basically owning a lot of companies. In the same way that in the travel space right now, it's pretty much just Expedia and Booking Holdings, and they own like all the online travel agencies in the world right now. Things like Priceline and Orbitz and Hotels.com, they're all owned just by a couple of companies. So I think this is the beginning of that kind of relationship between consumers and these conglomerates. So yeah, thumbs up for me on Grubhub. The next stock on this list is Shopify. So Shopify I really like it. I'll just go ahead and say that up front. So I do like that they're making e-commerce kind of like an open source thing. So they're making it a lot easier for small businesses and really small retailers. I'm talking about anywhere from 1 to 5 people own businesses to interact with their consumers and sell directly to them. So I don't think Shopify is trying to be Amazon, or they're not trying to become Amazon, I should say, in the sense that they're not really on the mission to own as many small businesses as possible. And the fact of the matter is, when you have something that becomes open source, kind of like software, you have a lot of software developers putting their best foot forwards. A lot of really good ideas flourish because of that. So I do like the idea of a community-ran e-commerce marketplace. So let's go ahead and take a look at Shopify's chart, which is pretty good, by the way. We're seeing some pullback, so support is still at the 200-week moving average. And yeah, anytime you see a company that has beat the highs of I want to say March. So basically, when the Nasdaq was making another higher high, if there's companies that have a higher high than the March high, especially in the tech field, that's considered pretty strong in my honest opinion. So Shopify did IPO here in the middle of 2015, and it's been going up ever since then. So from 2016 to now, it's gone up around 720%. So that's a huge percentage. This is kind of like Square. And I still think Shopify has potential to run. Anytime you have a really dominant e-commerce site, such as JD.com, Shopify, and Amazon, I think they're all pretty good buys. I would probably lump Alibaba in there too. So yeah, I do like Shopify. The next stock on this list is ISRG. So I actually don't know that much about ISRG, but I will read a couple sentences from this article about ISRG. So yeah, automation is happening everywhere. Everyone wants to talk about automated driving, but there's tons of automation happening everywhere else too, which is true. One automation space that is very promising is medical robotics. So this stock is pretty crazy. Why don't we take a look at the long-term chart? I'm surprised this has gone under the radar as long as it has. So ever since the lows in the 2008 recession, which was at $31, ISRG has gone up around 1,300%. So when you have a chart like this, it's almost as if everything has to go perfect in order for it to keep going in this trajectory. It's pretty high above its 200-week moving average. It's kind of parabolic at this point. So in my opinion, this looks kind of crazy. With that being said, though, if you do understand this industry a lot more than I do, see, to me, this feels kind of foreign because I don't, not only do I not know that much about the medical field, but it's not that publicly common to see assisted surgery or completely AI dominated surgery. So if I see it, then I'll probably feel like a little more comfortable with doing this, but this kind of feels like it's just speculation at this point. So I don't know. I'll leave it up to you guys. Still a question mark for me. Like I said, I don't know that much about it, so I'm probably not the best person to talk to about this company, but I still find it super interesting. So yeah, that's definitely one company I would keep an eye out on. The other thing I'll note is that ever since the, I want to say 2001 bottom of the tech bust, ISRG was around $5, and now it's about $521. So that would have been the time to buy, but still, I think it might. I don't know. I don't know how I feel about it. I would not buy right now because of that. So the next stock on this list is iRobot. Again, I'll go ahead and read a couple sentences off the article. So again, automation is happening everywhere. This includes in the consumer realm, where robots and other automated devices are being used to complete simple household tasks. I do think people are becoming more lazy. I don't think that will change. The thing with something like this, however, is that it's kind of an expensive cost margin. So iRobot does have to create their own products to sell and things like that. If in fact they're in the forefront of the consumer robotics space, which it seems like they are, I think they'd be a pretty good speculative buy right now. Let's go ahead and take a look at their chart. The chart's kind of choppy for me. Sideways consolidation and then up and then sideways. It reminds me a lot of Tesla. So up, sideways, up, sideways. Yeah, I don't know. I feel okay about this one. Not great. So I'm not going to talk about these two stocks, which is Palo Alto Networks or this stock right here, just because I don't know that much about that industry. But yeah, so let's see, 1, 2, 3. Okay, so I'll talk about 3 more companies, and then we'll call it a day. So this next company is Illumina. So Illumina is in the forefront of human genome sequencing, and what that basically means is that's a biomedical term for understanding our DNA. This is really important if we want to identify diseases and kind of solve the root problem of a lot of genetic diseases, and kind of prescribe medication for that, maybe alter DNA in that sense. So if you have a company like Illumina, which is always going to have government funding for solving a lot of diseases, especially in the biotech field or biomedical field, Illumina seems like a pretty good buy. So ILMN. It does seem kind of overbought right now. On the weekly chart, we have an inverted hammer. So if we do pull back a little bit, I would consider getting into this one. For those of you that know more about this industry, you could probably do some research on this one. But yeah, I think it's pretty interesting. The next stock is Match.com. So, or just Match. So Match is a conglomerate that owns Tinder and Match.com. Not only are people getting lazier, but they are getting lonelier, despite us being so connected. But yeah, so Match seems to be the stock to go if you want to profit off this business. The funny thing is, I had been watching this and I was like, wow, something really cool is going to happen. And then I completely forgot about it. And then I checked a week later and then it's like, look how amazing this move was off a week. That's just insane. So I'm like, dang it, I didn't think about it. But yeah, 36% in 1 week. So does this still have potential to run? I think so, especially when you have a company that's basically just software. They make money, they make revenue off the apps themselves, and there's always going to be more membership options and more ad revenue. So yeah, I do like it. I might wait for a pullback, but yeah, I do like Match. Right. Okay. So I do want to talk about Wingstop really briefly. The only thing I want to say is that I'm not crazy about it. I would probably buy something like Domino's before I buy Wingstop. just because I like the trajectory of Domino's a little bit better. I don't know. It's more established. It's been going on for longer. It looks like we're about to break out to all-time highs. In fact, I wouldn't hold my breath on trying to get a buying opportunity. It looks ready to break out again. So yeah, I'd probably rather have Domino's than Wingstop. The last thing I want to talk about is Etsy. So Etsy is basically an e-commerce giant, but it's kind of more of a niche market. So things like arts and crafts, it's possible. Yeah, it's kind of like a smaller version of Amazon. But I'm not super crazy about it, just because I feel like there's better options out there that I discussed already. That was a lot to talk about. I hope I didn't, smother you guys with information overload, but I hope you guys got a lot out of this video. Let me know which of these you found really interesting. I found all of them interesting in a sense, but I'm only going to talk about the ones that I know something about, or at least have something to say. If you recognize any of these companies, then tell me what you think about them. I do think, tech is going to be like where the money's going, especially AI. And this is not something that I've only thought of. I've heard a lot of money managers say this as well. I do listen to a lot of, not podcasts, but basically like public conferences about this kind of thing. Anyway, I hope you have a great night and good luck trading, guys.